All right, let's talk about a deal that's making some serious waves in the biotech world. We're talking about a massive $4.8 billion all-cash offer from Biomarin Pharmaceutical to buy up Amicus Therapeutics. Now, this isn't just another boring merger announcement. It's a genuine head-turner that has investors and the whole industry buzzing.
But here's the thing. This deal immediately brings up a huge question. The multi-billion-dollar question, really. Is the $14.50 per share that Biomarin is offering a fantastic payday for investors? Or is this a total steal, a heist, where Biomarin is snagging a company with way, way more potential for a bargain price? That's the mystery we're diving into.
Okay, so to really get why there's so much controversy around this price tag, we've got to understand what makes Amicus Therapeutics such a hot commodity in the first place. So Amicus is a big deal in the world of rare metabolic diseases. Their portfolio is anchored by Galafold, a really successful treatment for Fabry disease, and they've also got a new therapy for Pompe disease. But the really exciting part might be what's coming next. They have a drug for a rare kidney disease that's already in late-stage development, plus a whole pipeline of gene therapies. We're talking about potential one-and-done cures. That's a huge deal. And we're not just talking about future potential here. The numbers already back it up. In 2024, Amicus saw its revenue jump by more than 32%, hitting over $500 million. And here's the real kicker. By the third quarter of 2025, they actually became profitable. That's a massive milestone that shows they're moving into a whole new phase of financial strength. What makes this story even more compelling is the long-term picture. Their main moneymaker, Galafold, has its U.S. market exclusivity locked down all the way until 2037. Think about that. That's more than a decade of protected revenue, which is an absolutely crucial piece of the puzzle when you're trying to figure out what a company like this is truly worth. So you've got this strong foundation, a bright future. You'd think shareholders would be popping the champagne over a multi-billion-dollar buyout, right? Well, not exactly. The announcement was actually met with a total firestorm of opposition. So what's all the fuss about? And this wasn't just some grumbling on investor message boards. Oh, no. Within days, prominent law firms like Conswick and Fody were already announcing investigations, basically asking out loud if the board had done its job and gotten a fair price for the people who actually own the company. These investigations are basically boiling down to three huge questions. First, did the board really fight for the best possible price? Second, does this offer even come close to reflecting what Amicus is actually worth? And third, and this is a big one, could this whole deal get shut down by regulators? I mean, both of these companies are major players in the exact same markets for Fabry and Pompe diseases. That's definitely going to raise some antitrust eyebrows. And this all brings us back to the heart of the matter. What is Amicus truly worth? Because when you start to look at the numbers, you can see a pretty glaring gap between the offer on the table and what a lot of experts think. Okay, now this chart. This is where it all comes into focus. For a lot of people, this is the smoking gun. The offer from Biomarin is $14.50 a share. But look, before the deal was even announced, the average price target from analysts was already higher, at nearly $17. And even more striking, some of the high-end estimates had Amicus valued at over $29 a share. That is a massive difference. And the offer had an immediate and pretty telling effect on Wall Street. As soon as it was announced, major analysts, we're talking Citigroup, Cantor Fitzgerald, TD Cowen, they all just dropped their price targets right down to match the $14.50 offer. It's like the deal itself created a new ceiling, making you wonder if all that long-term potential was just being ignored for a quick cash payout. So this whole situation leaves investors standing at a crossroads. There are two very, very different ways this could all play out, depending on whether this deal actually goes through or if it falls apart. Let's just break down those two possible futures. If the deal succeeds, Amicus gets absorbed, it's delisted from the stock market, and shareholders get $14.50 in cash for each share. Simple. But if the deal fails, well, Amicus stays an independent company. Its stock would almost certainly take a nosedive in the short term, but then its long-term value would go back to being decided by its own performance and its own pipeline. A totally different ballgame. So, if you're an investor trying to figure out how to navigate this maze, what's your play? Well, the source material suggests a few different strategies, really depending on your timeline and how much risk you're willing to take on. Okay, for the short-term thinker, it's an arbitrage play. Basically, you try to buy the stock for anything just below $14.50 and cash out for a small, relatively safe profit if and when the deal closes.
Now, the midterm approach is more of a contrarian bet. You'd actually hope the deal fails. If it does, and the stock price tanks, say, down to the $7 to $10 range, that could be a huge, high-risk, but high-reward buying opportunity. And finally, for the long-term believers in Amicus, if the deal goes through, your only real option is to invest in Biomarin to get exposure to those assets you like so much.
And so, that brings us right back to our central mystery. Is $14.50 a share a fair price for Amicus? Or is this a slick move that's undervaluing a company whose true prize, its future, is being obscured? The final answer is going to unfold in the markets, and maybe, just maybe, in a courtroom.